Welcome back to the Florida Republic. So what did kill SVB Financial? It appears that not even the CEO knows. The former CEO of the morally bankrupt banking giant SVB Financial, Greg Becker, says that the modern record pace of federal rate hikes in Twitter, and Twitter, sure, why not, is why his bank went belly up in March. In a statement to Congress on Tuesday, Becker said the messaging from the Federal Reserve was that interest rates would remain low and that inflation that was starting to bubble up would only be transitory. Indeed, between the start of 2020 and the end of 2021, banks collectively purchased nearly $2.3 trillion of investment securities in this low-yield environment created by the Federal Reserve. They trusted the Federal Reserve. Now, at the beginning of this pandemic, when we increased our money supply by 35%, we at the Florida Republic explained that inflation would not be transitory and that there still is plenty of inflation coming in the future. This statement also included sentiment around the impact of Twitter and social media panic fueling runs on deposits. It's certainly clear that this was the first major banking crisis that featured mass social media, which could spread fear and panic at a faster pace than most other media could in the past. But this bank failed. Even if the run on the bank hadn't started, the numbers showed an institution overly reliant on the tech industry and a small number of venture capital, i.e. higher risk portfolios, at a time that the U.S. economy is barreling toward recession. This was a very undiversified bank, and it violated one of the basic rules of finance that should never be ignored in any economy. Don't put all of your eggs into one basket. Now, before I start gnawing off my hands in frustration over Becker's statement, allow me to point something out, simple irony. Becker was the CEO of a major bank whose regulator was the San Francisco Federal Reserve Bank. But he was also a Class A director at the San Francisco Fed, one of three banking executives who represented the member banks in Mary Daly's district. He couldn't look at his balance sheet early on and stress test it and discuss this problem about the impact of hold to maturity with the Fed board and its directors even sooner. That side note is off, okay? Increasing interest rates was not the underlying problem. Instead, you have to revisit the issue that created the situation in the first place. And a lot of people in finance understand this, but a lot of people don't. And that is the role of banking and the importance of fractional reserve lending. The modern banking system operates around a system known as fractional reserve lending. In this case, customers place their deposits into the bank, their life savings, employee payrolls, and much more. So people are looking for a safe place to put their money, get a checking account, because under the mattress and in the walls, it doesn't work. The problem starts with the Federal Reserve's rules that only require that banks keep just a fraction of total deposits as reserves. And this creates a situation where two people simultaneously hold claims on bank capital, the depositor and the person receiving the loan. And the bank is in the middle of both transactions. This situation creates a handful of potential problems, and let's look at the most obvious ones. The first, bank runs, are the most apparent in fractional banking. When many depositors lose confidence in a bank and try to withdraw all their money simultaneously, the bank might not have the capital on hand to fill the gaps. But it's not just lending that was the problem in companies like SVB. U.S. banks bought almost $2.3 trillion in investment securities that couldn't be sold without making some of them, if not most of them, insolvent. And owning these bonds created that issue of liquidity in the banks like SVB. And that brings up the next problem, which is moral hazard. Fractional lending can try to make as much money as possible by buying investment securities and expect them to all receive bailouts if they fail or things go awry. The expectation of bailouts or moral hazard can lead banks to take on larger risks without thinking about the possibility of broader market instability or unforeseen challenges like inflation or a recession. Now, as I've noted before, the Federal Reserve was created in order to prevent the boom and bust cycles of the 1907 panic and the economic distresses of the late 19th century. But the Fed today has largely been responsible for the boom and bust cycles of the 21st century. Banks create new money through lending and fuel periods of economic expansion, and when improperly managed, the banks might lend too much and create bubbles. Even more concerning, the Fed is the regulator responsible for ensuring the reserve requirements are manageable to ensure safe lending practices and prevent overheating in the economy. However, the Fed dropped the reserve ratio requirements to 0 after COVID and waited too long to re-raise them. It's helped fuel a massive post-pandemic bubble, and now that is deflating at a remarkable rate and taking on victims like SVB Financial in the process. Now, finally, one last other element is that fractional reserve lending can and will worsen economic inequality. The reason's pretty simple. When we expand credit, we can fuel price inflation across asset classes. The problem is that many people don't have access to credit or don't have a significant amount of assets. They'll face higher interest rates, and that can fuel the prospect. That can't fuel the prospect of having money to make money. The central bank's policies in fractional reserve lending have played a significant role in the appreciation of equity and real estate assets over the last 25 years, in line with the dramatic expansion of the money supply and the financialization of the economy. On Tuesday, SVB's financial president will sit before Congress, and we'll all have a nice show about failed banks. Of course, they'll blame the Fed's transitory inflation argument and hedge funds sending notes on Twitter for the bank's failures. However, if the House Select Committee were smarter, they'd haul in the regulators who fueled the collapse in these banks and explored the role of fractional reserve lending. We might also ask why we just don't have banks that provide basic services that aren't using depositor capital to fund boom and bust cycles. That's all today. I'll see you out there.